Welcome back to the deep dive. Kiss's restructuring will take time. Hello and welcome to Insight AI Brief Setai.
Hi there.
Today we're talking about Kiss stock, Rojukis International, ticker's Kiss.
That's right. And they've just put out their Q2 2025 numbers.
Before we begin, please don't forget to like, share, and subscribe.
So yeah, Q2 results are out, and frankly, they're a bit of a mixed bag. Management's pushing this big strategic shift, Rojukis 3.0.
And the analysts seem kind of divided on it, right?
Exactly. That's the core tension here. You've got this headline net profit number that looks, well, pretty weak on the surface.
Concerningly weak, yeah.
But then management says, look, this is intentional. We're overhauling things, causing some short-term pain, financial compression for what they hope is long-term gain, particularly regional dominance.
Okay, so our mission today is to sort of cut through that noise for you. We need to understand the real underlying health of the brand itself.
Which seems strong based on consumer sales.
Right, and weigh that against these short-term costs, the restructuring pressure. So let's start with the financials. Q2 2025, what do those headline numbers actually look like?
Well, if you're just looking at the bottom line, the profit, it does look a bit rough. Q2 net profit came in at 23.22 million Thai baht.
And that's down quite a bit year over year.
Yeah, significantly, down from 38.70 million baht in Q2 last year.
Wow.
And if you zoom out to the first 6 months, 6M 2025, total revenue was 512.5 million baht. Net profit for that period, 59.30 million baht.
Also down from last year.
Yep, down from 69.71 million in the first half of 2024. Some key ratios for the 6 months. EPS at 0.10 baht, net profit margin around 11.5%, and ROE 14.4%.
Okay, so that profit drop, nearly 39 million down to 23 million in just one quarter. That's the number people see.
Yeah.
How can management spin that positively?
Well, it comes down to this really crucial difference between sell-in and sell-out. It's a massive distinction here.
Explain that. Sell-in is what they report as revenue.
Exactly. Sales into the retailers, and yes, that number dipped. But sell-out, that's the product actually flying off the shelves, what consumers are buying that grew, and it grew strongly.
How strongly?
Robustly. 17.3% growth in Q2 2025 consumer sales. Reached 468.6 million bautas.
17%. Okay.
So that number tells you, look, the demand for Kiss products, that's definitely not the issue here. People want this stuff.
Right. So if consumer demand is surging like that, why did the reported revenue, go down? You're saying management basically chose to sell less to their retail partners. Why?
It was, a very conscious strategic move. They wanted to clean up the supply chain, basically, optimize it, and importantly, boost their cash flow velocity.
How did they do that?
They specifically targeted inventory held by semi-credit retailers, cut that inventory by 50% in the first half of the year.
50%. Okay. So they're pulling back on maybe some less reliable partners, normalizing inventory levels.
Pretty much. Normalizing distribution, pulling back on what they saw as maybe excessive credit risk. They see it as like a surgical strike. It hurts the H1 revenue number, sure, but it sets them up for a much stronger, healthier second half.
Okay. That makes sense strategically. But cleaning house isn't free, right? We saw selling, general and admin expenses, SG&A, jump pretty sharply. What was it, up to 41% of sales?
Yeah, 41% from about 36% last year. A noticeable jump.
So how do we know that near 5% spike in SG&A is actually strategic investment and not just, runaway costs or maybe some bloat from the new management team?
Well, they trace it pretty directly to the strategy, the Rojukis 3.0 stuff under the new CEO.
Yeah.
It's mainly two things: market expansion costs, both here in Thailand and internationally,
Okay.
and deliberate brand investment. They spent quite a bit on advertising, getting new presenters, online campaigns, events,
Yeah.
building that brand awareness.
Then R&D.
And R&D, yeah. They're ramping that up. Sourcing a lot from Korea, actually. And they have a specific goal for that R&D spend. Boost the gross profit margin by 0.5% every single year through premium innovative products.
So spend now on the brand, on expansion, on R&D, betting it pays off later with higher margins and wider reach.
Exactly. That's the essence of Rojukis 3.0. It really kicked off when the new CEO, Corrado Jacinto, came on board in January 2025.
And the long-term vision. I heard some big numbers.
Huge numbers. They're targeting 4 billion Thai baht in revenue by 2030.
4 billion.
Wow. And they want to back that up with sustained annual profit growth of like 15 to 25%, and average annual revenue growth around 20%.
Okay, 4 billion by 2030. Is that, Is that realistic? Or is it just a classic new CEO setting a super high bar to get the market excited? Do they have the foundation for that kind of ambition?
Well, the domestic foundation does look pretty solid, which gives the target some credibility, you know? Their core products are doing really well.
Fuck what?
Face masks, they're the market leader there. Grabbed an 18.2% share in Q2 this year. That's up significantly from 13.7%.
Okay, dominant there.
And moisturizers are growing too, market share up to 5.3% from 4.7%. So they're using that strength, that leadership to push into newer, maybe higher value stuff.
Like the face, eye, neck treatments.
Exactly. Those, the Reju, PDRN, phytoretinol products, they also launched a Pore Bright cream with SPF 50. They're also trying to build share in face cleansers. The goal seems to be undisputed leadership in face care in Thailand.
So domestic market is strong, it's the innovation engine. But that $4 billion target, that has to involve going international in a big way, right?
Oh, absolutely. International expansion is now like a core pillar of the strategy. That's where the major growth fuel is supposed to come from.
What are the goals there? How much international revenue are they aiming for?
They want to ramp it up fast. International was only about 2% of revenue in 2024. The internal target for the end of this year, 2025, is apparently 7 or 8%.
From 2% to 7 or 8% in 1 year.
Yeah. And longer term, by 2030, they want international to be 20% of the total revenue. That's the big jump needed to hit that 4 billion baht scale.
20% international. That's a massive shift. Where are they focusing their efforts first? Which markets?
Vietnam is the main target right now. They feel they can leverage their experience with the modern trade channel there.
Makes sense.
They're also moving quickly in Laos and Cambodia, setting up distribution, expecting the first shipments maybe September, October this year.
Okay.
And they're also pulling forward plans for the Philippines, trying to accelerate entry there, probably to diversify the risk a bit.
Speaking of risk, moving that fast internationally, there've got to be headwinds, right? Have they hit any snags?
They have. Management did acknowledge external factors, specifically delays with the Vietnam FDA approvals. That's a key risk they mentioned.
Regulatory hurdles. Always a potential issue.
Right. And because of those delays, plus that inventory cleanup we talked about in the first half, they actually had to revise their overall 2025 growth target down.
The initial one was 10-15%.
Yeah, initially 10-15% for revenue and profit growth this year. They've adjusted that down to a 7-12% range now.
Okay, 7-12%. But given the weak first half, hitting even that revised target implies a huge acceleration in the second half, doesn't it?
It really does. Analysts like Capricorn Securities pointed this out. They estimate management needs something like 24% to 33% profit growth in the second half just to land within that 7-12% band for the full year.
Wow, 24 to 33% growth in 6 months.
Yeah.
That sounds incredibly tough, especially during a restructuring.
It is. Capricorn Securities used the word challenging. They noted that achieving that kind of rapid profit jump will be difficult and that finishing a restructuring of the scale, well, it's just going to take time.
So they're basically asking investors to look past the current pain, believe in the H2 recovery, and focus on the long-term story.
Pretty much, which explains why the analyst community is kind of split, right? You've got the optimists focusing on that 2030 vision and the skeptics focusing more on the immediate profit challenges.
So what do the price targets look like? What's the range?
It's quite wide. On the bullish side, you had K Securities back in March with a buy rating and a target price of 4.77 bait. They were clearly betting heavily on the Rojika's 3.0 plan working out.
Okay, that's the optimistic view. What about the more cautious take?
More recently, Capricorn Securities, or KS, they put out a hold rating. Their target prices were lower, around 3.25 bait, maybe down to 2.92 bait.
And why the caution there? Valuation?
Yeah, valuation context was a key part of it. Analysts point to the PER ratio for 2025-2026, hovering around 13.3x to 13.5x. Their point is, given the immediate pressures from the restructuring costs and the higher SG&A, the stock isn't exactly cheap right now.
Okay, so if the profit picture is tricky in the near term and the valuation isn't a bargain, what's stopping the stock price from falling further? Is there a safety net?
The dividend. That seems to be providing quite a bit of support.
What's the policy there?
The company has a policy to pay out not less than 50% of net profit based on their separate financial statements.
And they just paid one.
They did. Just announced 0.10 baht per share for the first half of 2025 results. XD was August 27th, payment September 12th.
And that translates to a decent yield?
A pretty attractive one, actually. Analysts estimate the dividend yield is somewhere between 6.3% and 6.8%.
Oh, okay.
And they see that relatively high, stable yield as limiting the downside risk on the stock price. Even while the company is going through this big transition, it provides a solid floor.
Right. Let's connect back to something we discussed earlier, that strategic decision in Q2 to cut inventory at retailers to improve cash flow. Why was cash flow under pressure to begin with?
Yeah, good question. You have to look back a bit at their historical liquidity numbers to see why that Q2 move was probably necessary.
What do those show?
Well, historically, their current ratio had declined. It got down to around 1.8x at one point, but more critically, their cash conversion cycle had gotten really long.
How long?
Annualized data at one point showed it stretched out to like 242 days.
Wow, that's long.
Why?
It was mainly driven by their expansion into the modern trade channel. Big retailers, supermarkets, etc.
And those big guys demand longer payment terms, right?
Exactly. Their average collection period for receivables, the time it took them to get paid, ballooned to about 162 days because of the terms demanded by those large modern trade customers.
Okay, so almost half a year just waiting to get paid on average.
Yeah. So that Q2 inventory reduction, it wasn't just about optimization. It looks like a necessary move by the new management team to relieve some of the acute strain caused by that really lengthy cash cycle. It helps ensure they can actually fund the aggressive expansion they're planning without running into serious liquidity problems. #tag outro. So, let's try and wrap this up. Reducus International. KISS, they're definitely going through it right now, enduring some very intentional, quite costly short-term disruption.
The inventory cleanup, the spike in SG&A.
Right. All to fund this ambitious long-term plan, Reducus 3.0. But underneath all that noise, the underlying consumer demand, that sellout number, it still looks exceptionally strong. That's kind of masking the current financial turbulence.
So the big question we want to leave you with is this.
Mm-hmm.
If, and it's still an if, but if this ambitious international push into Vietnam, Laos, Cambodia, the Philippines, if it actually works, if they hit that huge 20% revenue contribution target by 2030, how quickly do you think the market will just forget about all this short-term noise, the profit dips, the restructuring costs we're seeing today? Something to think about. Finally, if you have any other stocks you'd like us to cover, please do let us know in the comments. Don't forget to like, share, and subscribe to support our team. Thank you.